Hi guys, welcome. AMD and Intel have both reported their quarterly earnings the past week. While both have reported good revenue and profits, there is one that is looking like a better bet for the longer term. In this video on AMD versus Intel stock analysis, I'm going to dive into the financials to see which one is worth investing in. So let's jump right into it. Here's the quarterly revenue chart going back to 2016. Both companies' revenue has grown in this period. However, AMD is growing at a faster pace. Intel's revenue has started to flatten in the past 4 quarters, while AMD has continued to grow at 93% year on year. So AMD scores a point here. I'll keep the scores as we go through the numbers and tally them up towards the end of the video. The same pattern is repeating for the gross profit. AMD is growing at a rapid pace and the gross margin has been on the rise from the lows of 31% to 46%. While Intel's gross margins are coming under pressure. Still, as Intel has a higher margin, Intel scores a point here. But all that gross profit needs to be translated into a net income through the efficient organization and management of the company. Here we can see Intel's net margin is just 17%, almost same level as AMD's 16%. So both score a point. This chart shows the ratio of allocation of revenue in R&D and sales, general and administration. R&D investment is especially important for technology companies as they need to continuously develop better products to keep their market share and maintain their margins. Both AMD and Intel invest a good portion of their revenue into R&D at 17.7% and 18%. Both score a point each. The free cash flow is the real earnings that are left after investing in capital needed for continued business operations. It is derived by taking the operating income and deducting capital expenditures. Growing free cash flow shows that a company is still growing its income. AMD is still growing. The line chart shows the free cash flow growth and the trend is pointing upwards. So AMD scores a point here. The quick ratio represents the ratio of total available cash and cash equivalents over the total current liabilities. It is used to measure the company's ability to service its short-term financial obligations within the next 12 months. A ratio of 1 or above is preferred. Both AMD and Intel's quick ratio is below 1. But since AMD has a higher one at 0.6 and also since Intel's is very low at 0.2, AMD scores a point. Intel has a huge mountain of long-term debt at $33 billion. And AMD has $303 million of debt. Furthermore, the trend of AMD's debt has been reducing. Debt is an important financing instrument that allows companies to leverage and grow, but only up to a certain point. The ratio of long-term debt over total assets shows Intel at 22% and AMD at just 3%. AMD scores another point. The effect of Intel's huge debt can be better appreciated using this chart of interest expenses versus net income. Intel's interest expense is $190 million versus net income of $3.4 billion. That is 5.6% of net income. AMD's interest expense is just 1.6% of net income. AMD scores another point here. Intel has a stock repurchase plan but AMD does not. Intel scores another point here. Intel has a higher book value at $21.77 and AMD at $5.53. This is the value of each stock of the company. It is calculated by taking away the total liabilities from the total assets to arrive at the net value and dividing that by the number of shares. But to make a comparison, we need to convert the book value to price to book value. Here, we take the current price of each stock and divide it by the book value per share. Value investors look for profitable companies that are traded below 5 price to book. But it is very hard to come by and you must also be very careful. Sometimes companies that the market has given up may end up with such low valuations. Intel scores a point here at 2.7 price to book. Intel's price has come under pressure after the recent earnings report due to their $2.2 billion provision for ongoing legal litigation. I have covered this in great detail in my recent Intel stock analysis video. You can find it linked in the description box below. Intel has a dividend policy in place as well, and AMD does not give out any dividends. Intel scores a point. The trailing PE ratio for AMD is moderately high at 34, but has dropped from the high of 150 achieved in 2018 due to improved profitability since then. If AMD continues to book in further profits in the next quarters as they have projected, the PE ratio will come down to more reasonable levels. Intel's PE ratio is 13, and so Intel scores a point. Peter Lynch, the famous fund investor, popularized the PE to growth ratio. It measures the PE to revenue growth. It is designed to evaluate the price of a stock by also taking into account the revenue growth. A value of 1 indicates that the price is growing at the same pace as the revenue. A value above 1 indicates an overpriced stock, and a value of below 1 an underpriced stock. For this analysis, I'm using the trailing PE ratio over year-over-year revenue growth that I shared in the very first chart. Based on this, AMD is an undervalued stock at 0.4, and Intel's PEG ratio does not count as their year-over-year revenue growth is negative. That is, their revenue is not growing. AMD scores a point. Score time. Let's tally the scores. AMD is winning, but by only a small margin. AMD scored 9 and Intel 7. AMD scored well for growth-related criteria such as PEG ratio, year-over-year revenue growth, and also low debt levels. Intel, on the other hand, scored well for valuation as the PE ratio and price to book are low due to their lower stock price, but they fared poorly in the growth areas. My preference would be to invest in AMD for the longer-term growth prospects. Subscribe to my channel if you have found the sharing useful, and hit that notification bell so that you don't miss out on any of my future videos. Do let me know if you'd like me to do a video on any other stocks. And I'll see you soon in the next one.